Okay, let's be real. The headlines are everywhere, and if you're looking at your portfolio, that sea of red is probably burning a hole in your screen. After an insane run, the AI bubble is finally showing signs that it might be popping. We're seeing this sharp sell-off in tech stocks, and it seems like it was all kicked off by one announcement from one AI company. But that was all it took. It was the pin that hit the balloon. In just the past week, the software sector got hammered. The S&P 500 software index lost something like $1 trillion in value since late January. This isn't just a small dip. It's a stampede for the exits. And it's all fueled by one terrifying question. What if the AI you invested in is actually designed to make your other investments worthless? For a lot of people, this is a scary moment. It feels like a threat to your retirement account, your college fund, your whole financial future. And it looks a lot like the dot-com crash in 2000. Seriously, the parallels are screaming at us. The market has been riding this AI wave, and now everyone's wondering if it was all just a sugar rush that couldn't last. With all this fear, and with analysts basically treating every software company as guilty until proven innocent, you'd think the smart move is to sell. Just cut your losses and get out. And that is exactly why I need to show you my strategy for getting through this, and explain why I'm not selling a single stock. Let's break down what just happened, because it shows you how fast the market can flip. The first domino was a company called Anthropic, a big player in AI. They announced some new tools for their chatbot, Claude, specifically a feature called Coworker that can automate really complex professional jobs, like reviewing legal documents or tracking compliance. Sounds like a simple product update, right? But the market heard something totally different. They heard the end of entire industries. Almost immediately, stocks for legal software companies in the US and Europe just started to tank. The thinking was pretty simple. Why would a law firm pay thousands for software when an AI can do it better and faster for way cheaper? And it didn't stop there. The fear was contagious. It spread from legal software to pretty much the entire software as a service or SaaS world. Companies like Salesforce, Microsoft, and Adobe all took a big hit. Then, the panic even jumped to the chip makers, the companies literally building the AI engines. Nvidia and other semiconductor stocks dropped as investors started to doubt the whole ecosystem. What we saw was the market starting to price in obsolescence. The same tech that was supposed to lift every company up is now seen as something that could eat its own. Investors are realizing this isn't a rising tide that lifts all boats. It's a force that creates winners and losers, and suddenly nobody wants to be caught holding a loser. This fear gets even bigger when you see the money being poured into AI. The big tech companies are planning to spend over $600 billion on AI in 2026 alone. Amazon and Google are saying their spending is about to go through the roof. This has created what some people are calling a bottomless pit. Investors see all this money going in, but it's getting harder and harder to see how it's going to turn into a profit. It kind of feels like the emperor's new clothes, where everyone's suddenly afraid to admit they don't see the profits. We're seeing a huge reevaluation of what AI actually means for the economy. The blind optimism phase is over. Now, we're in the fearful phase. Investors hate uncertainty, and right now, tech has never felt more uncertain. If this feels familiar, it should. This whole pattern, hype over a new technology, tons of overinvestment, and then a painful crash, has happened over and over. To really get how serious this is, we have to look back at the biggest bubble we've seen, the dot-com crash of 1999-2000. Back then, the story was the internet. It was going to change the world, and all these companies with .com in their name went public, promising to revolutionize everything. Investors had major FOMO and poured money into them, even though most had no profits and no real business plan. The Nasdaq, which was full of these tech stocks, just soared. And then the music stopped. In March of 2000, the bubble burst. Over the next 2 years, the Nasdaq crashed by a crazy 77 to 78%. Companies that were once worth billions went bankrupt. Pets.com, Webvan, eToys, they all became jokes, symbols of how irrational things got. People who speculated got wiped out. Retirement accounts full of tech stocks were destroyed. It kicked off a recession and a long, painful bear market. The similarities to today are chilling. We have the same kind of hype, just this time it's all about AI. We have trading apps and social media making it feel like a game, creating these frenzies around certain stocks. And we see the same flood of money into any company that even mentions AI, whether it makes sense or not. But these echoes go back even further than the dot-com bust. Think about the railroad boom in the 1800s. Railroads were the big, new, transformative tech. That led to a huge investment boom where everyone was building rail lines, a lot of them to the same unprofitable places. The result was a bunch of financial panics and busts when the companies went bankrupt. The growth eventually happened, but not before a painful crash. It's the same pattern as the 1929 crash, which came after the Roaring Twenties, when new tech like the radio and the automobile fueled this speculative craze on Wall Street where regular people were buying stocks with borrowed money. When that bubble burst, it triggered the Great Depression. In every one of these cases, the story is the same. A new technology creates a wave of hype. That leads to an investment bubble where prices get disconnected from reality. Eventually, reality hits, the bubble pops, and the market crashes. The AI boom seems to be following this exact playbook at a terrifying speed. So, what are the warning signs right now? What is it about this bubble that has people so worried? It's a mix of insane valuations, these weird investment cycles, and a huge gap between the hype and reality. For one thing, the valuations are just extreme. You have AI startups getting valued at tens or even hundreds of billions of dollars before they've made any real money, let alone a profit. And this isn't even the first AI bubble. Back in the 80s, companies like Symbolics and Thinking Machines were the big AI names. They sold these expensive, specialized computers with a ton of hype, but they collapsed when cheaper computers came along and the AI revolution didn't happen fast enough. And then you've got this really concerning cycle of investment happening. Check out the relationships. Microsoft is a huge investor in OpenAI. Amazon is a huge investor in Anthropic and builds their data centers. NVIDIA invests in cloud companies, and those companies then buy NVIDIA's chips. Basically, the biggest tech companies are funding the AI startups, and the startups are using that money to buy services right back from those same tech companies. It makes it look like there's this massive organic demand, but it can also look like the giants are just paying themselves and inflating the value of the whole ecosystem. On top of all that, there's a growing gap between the money being spent and the money being made. For a while, the AI story was so strong that nobody really questioned it, but the data is starting to look a little ugly. A recent MIT study looked at companies that had spent between $30 and $40 billion on generative AI projects. The result was pretty shocking. 95% of them saw zero return on that investment. Some analysts are calling this the Cisco moment, referencing the dot-com giant whose stock fell over 80% because the promised productivity gains just didn't show up fast enough for investors. We're in a one-note narrative, fueled by endless spending. The market rewarded the companies building the stuff, like NVIDIA, but it's becoming clear that businesses are adopting AI a lot slower than the infrastructure is being built. That mismatch is a huge red flag. We've hit a turning point. In 2024 and early 2025, if you just whispered A and I, your stock would go up. Now, investors are finally waking up and asking for proof. The market wants to see a return on this giant investment. And hey, speaking of returns, my bank account is demanding proof this channel will ever make me back my money or time. And as a college student, believe me, that's a big deal. So if you're getting any value out of this, I'd really appreciate it if you'd like and subscribe. With all this fear, with the charts flashing red and the headlines screaming about a crash, you'd probably think I'm selling everything. You'd assume I'm getting out of my tech stocks and just waiting for this to blow over. But I'm not. I haven't sold a single stock, and I have no plans to sell. It's not because I'm just ignoring the risks. It's because my entire investment strategy was built for moments just like this. It's a strategy I've built on history, logic, and what I believe about how wealth is really built. Selling now, in a panic, would be the single worst mistake I could possibly make. And in the rest of this video, I'm going to walk you through exactly why I'm holding on. This is where we need to separate emotion from strategy. The fear is real, but making money decisions based on fear is almost always a losing move. My decision to hold on comes down to a few core ideas. It's about knowing the difference between today and 1999, keeping a long-term mindset, and honestly, just sticking to some simple rules. So let's start with the biggest difference. This is not the dot-com bubble. Yeah, the hype feels the same, but the companies behind the AI boom are completely different. In 2000, the market was full of zombie companies. They had no profits, no real path to making money. They were just built on hype. Today, the leaders of the AI revolution are some of the most profitable companies in history. I mean, look at NVIDIA. It didn't soar on a promise. It soared because its financial results were insane. In its third quarter fiscal 2026 report, the company announced record data center revenue of $51.2 billion and said they expect around $65 billion for the next quarter. These aren't just made-up numbers. This is real. Explosive growth from a company that can't make its chips fast enough to keep up with demand. These companies aren't the pets.com of today. They have multiple ways of making money, huge competitive advantages, and they're bringing in tons of cash. That means they can handle a downturn and come out even stronger. The dot-com crash wiped out the weak companies. This is more like a violent, but maybe healthy correction that just washes out the hype. Another huge reason I'm not selling is my time horizon. I'm not a trader. I'm an investor. Traders try to time the market. Investors know that's basically impossible. The focus should be on time in the market, not timing the market. History shows us this. Let's go back to the dot-com crash. If you invested in a NASDAQ index fund at the very peak in March 2000, you would have watched your money drop by over 75%. It would have been terrifying. It took about 15 years to get back to that high. But if you had just held on, the long-term returns would have been amazing. More importantly, if you had owned the survivors like Amazon or Apple and just held on, you would have made life-changing money. Amazon's stock fell over 90% after the bubble burst. Selling would have felt like the smart move, but holding on through that pain would have turned a small investment into a fortune. Volatility is just the price you pay for long-term returns. Selling in a panic locks in your losses and then forces you to make another impossible choice. When do I get back in? People who sell because they're scared often wait too long. They miss the huge rebound, and they only buy back after the market has already recovered. So they end up buying high after selling low. And all of this is supported by the unemotional rules I use. In chaotic times, you need a system, not predictions. For me, it starts with diversification. I am invested heavily in tech, but I also own broad market index funds, like an S&P 500 ETF. That gives me a piece of the whole economy. It cushions the blow when one sector gets hit hard. Then, you have to look at dollar-cost averaging. This is the best tool for an average investor. I invest the same amount of money every single month, no matter what the market is doing. When prices are high, my money buys fewer shares. When the market crashes, like right now, that same amount of money buys more shares at a discount. So instead of fearing a crash, I see it as a sale. And just as important as keeping a cash reserve, I never invest money that I might need in the next 2 or 3 years. Having an emergency fund is so important because it means you're never forced to sell at the worst possible time. If you lose your job while your portfolio is down 40%, you might have to sell at a huge loss just to pay your bills. Cash gives you the freedom to wait out the storm. And finally, I focus on quality. I invest in the leaders of industries, companies with healthy finances and clear advantages over their competition, the kinds of companies that can survive a recession and actually steal market share from the weaker players. So, yeah, the AI stock market crash is here. It's scary, it's volatile, and there's probably more pain coming. The headlines are going to get worse. Your gut is going to tell you to sell. But bubbles bursting are a normal part of how markets work. They're like a fire that burns away all the hype and deadwood so that healthier things can grow. The trick is not to get burned yourself. You can choose to react to all the noise and fear, trying to time something that's impossible to time. Or you can choose to follow a plan. You can remember that even though the hype feels the same, this time is different because of the real profits being made. You can take a long-term view and understand that downturns don't last forever, but innovation does. You can stick to a disciplined strategy of diversifying, dollar-cost averaging, and focusing on quality. I'm not selling a single stock because I'm playing a different game. I'm not investing for next month or next quarter. I'm investing for the next 10 years and beyond. And history has shown, over and over, that for people who can stay calm and stick to a plan during moments of maximum fear, the rewards are incredible. This isn't the time to panic. This is the time to stick to the plan.